The morning silver crosses $100, the price itself will not be the real shock. The real shock will be how many hidden parts of the financial system suddenly start showing stress at the same time. Because metals do not explode in price without a reason. When a critical industrial metal jumps that high, it usually means supply chains, credit markets, or investor confidence are already under pressure. At first, news anchors would frame it as a historic rally, but inside trading desks, risk managers would already be calculating which exposures could spiral out of control. Before we go deeper, if you want calm breakdowns of financial warning signals like this, subscribe now and stay with Bullion Alert HQ so you never miss the shifts before headlines hit. The viewers who understand these moves early are always the ones who stay ahead of the panic later. Most everyday investors think a higher silver price simply means mining companies earn more money. In reality, a sudden spike to $100 would instantly raise costs across multiple core US industries. Solar manufacturers would be among the first to feel the pressure. Modern solar panels require significant silver input, so a price shock would hit production budgets almost immediately. Large energy projects planned years in advance would suddenly face unexpected cost overruns. That forces companies to either delay expansion or pass costs directly to consumers. Electronics manufacturers would face the same issue within weeks. Silver is used in circuit boards, connectors, medical devices, and advanced computing components. Unlike some materials, silver cannot always be replaced without performance loss. That means companies often have no cheap substitute during sudden shortages. Procurement departments would rush to secure long-term supply contracts. That urgent buying itself would push physical premiums even higher. At the same time, bullion dealers across the United States would start reporting inventory stress. Retail investors seeing triple-digit silver headlines would flood into physical coins and bars. This surge in public demand tends to happen emotionally rather than logically, and emotional buying waves often drain available retail supply faster than wholesalers can replenish. Meanwhile, futures markets would become extremely volatile. Traders holding large short positions would face rapidly increasing margin requirements. Some funds would be forced to close positions simply to survive liquidity rules. That forced covering would create additional upward pressure, feeding the rally further. Banks exposed to commodity derivatives would begin tightening risk models. Whenever banks tighten risk simultaneously, credit availability across the economy quietly shrinks. This credit tightening rarely appears instantly in headlines, but businesses depending on revolving credit lines would start noticing stricter lending conditions within weeks. Transportation companies would feel secondary effects next. Higher electronics and equipment costs eventually flow into logistics pricing and maintenance budgets. Defense contractors would also face uncomfortable procurement adjustments. Many military technologies rely on high-conductivity silver components that cannot easily be redesigned. Government agencies would likely downplay the situation publicly. Internally, however, supply planners would begin reviewing strategic material reserves. Commodity hedge funds would experience extreme inflows from momentum investors. Fast capital entering small markets tends to exaggerate every price movement. Financial television would invite analysts to debate whether the rally is temporary or structural. But institutional players rarely wait for TV consensus before repositioning portfolios. Large pension funds historically move slowly, but once allocation committees react, their orders are enormous. Even a small percentage shift into metals from retirement funds could overwhelm available supply. This is why triple-digit silver would not behave like a normal commodity rally. It would behave more like a stress signal flashing across multiple financial layers simultaneously. Currency markets might also react subtly at first. Rising precious metal prices often reflect declining long-term confidence in fiat purchasing power. If investors interpret silver's rise as an inflation warning, bond markets could start repricing interest rate expectations. That repricing would affect mortgages, corporate loans, and federal borrowing costs. Housing markets are extremely sensitive to interest rate shifts. Even small yield increases can slow home affordability dramatically. Stock markets would initially celebrate mining companies and commodity producers. But broader indexes might turn unstable if inflation fears begin dominating investor psychology. This psychological transition is usually the true turning point. Markets can handle high prices, but they struggle when participants start questioning system stability. At Bullion Alert HQ, we track these psychological tipping points more than daily charts. Because once belief shifts, price movements tend to accelerate far beyond analyst forecasts. If silver ever reaches $100 quickly, it would not just represent investor excitement. It would represent a signal that something deeper in supply, currency trust, or global production has already tightened significantly. And the moment that realization spreads, the second phase of the reaction would begin. That second phase is where the real financial chain reactions start unfolding. Once the market accepts that silver is holding near $100, the focus would shift from excitement to consequences. Investors would begin asking not how high silver can go, but why it climbed so fast in the first place. That question alone would trigger deeper investigations into supply data and warehouse inventories. Analysts would start comparing official stock numbers with real industrial consumption rates. If those numbers showed tight physical availability, confidence in paper trading structures could weaken. And when confidence weakens, traders begin demanding stronger guarantees instead of simple contract exposure. Large institutional buyers might quietly move toward allocated physical storage. This shift from paper claims to direct ownership tends to reduce available floating supply even further. Reduced floating supply increases volatility dramatically. Even small buy orders can push prices sharply when liquidity becomes thin. Retail investors watching financial news would likely feel urgency building. Social media discussions would explode with predictions, fear, and aggressive price targets. Emotional retail waves often arrive late but move fast. When millions of small investors rush simultaneously, coin shops and online dealers can sell out within hours. Premiums over the official spot price would likely widen across the United States. Buyers would notice that the real purchase cost is far higher than the number shown on TV. That price gap alone creates psychological tension. People start realizing the market price and the obtainable price are no longer the same thing. Industrial procurement teams would now face contract renegotiations. Suppliers unable to lock earlier prices would pass higher material costs forward through the manufacturing chain. Consumer electronics could quietly become more expensive months later. The public might never connect the price increase back to silver, but the financial ripple would still be there. Energy infrastructure projects could slow if component costs overshoot original budgets. Investors funding those projects might demand revised return projections before releasing additional capital. Banks monitoring inflation indicators would notice commodity pressure spreading beyond energy. Precious metal spikes often signal deeper monetary stress rather than isolated supply issues. If inflation expectations rise, bond yields typically react. Rising yields tighten financial conditions across nearly every borrowing sector in the economy. Companies carrying heavy debt loads would feel that pressure first. Refinancing becomes more expensive, and expansion plans often pause during uncertain credit environments. Stock market volatility would likely increase as analysts revise cost projections. Markets dislike uncertainty more than they dislike bad news. At this stage, silver itself becomes less important than what it represents. It turns into a visible thermometer measuring trust in currencies, production stability, and global trade confidence. Television debates would focus on whether the spike is temporary speculation or structural repricing. But institutional money rarely waits for that answer before adjusting exposure defensively. Some funds would diversify into other hard assets. Others would increase cash buffers to prepare for wider market swings. Household investors watching retirement accounts might feel uneasy. Sudden commodity shocks often create the impression that broader financial turbulence could follow. This emotional reaction can influence spending behavior. When consumers feel uncertain, discretionary purchases often decline quietly over time. Slower consumer spending eventually affects corporate earnings forecasts. Earnings pressure then feeds back into stock market sentiment, completing the economic feedback loop. None of this means a silver rally automatically causes a financial crash, but it does mean that extreme metal prices often appear alongside deeper structural stress signals. Financial history repeatedly shows that markets rarely send only one warning sign. They usually send several, and commodities are often among the earliest. That is why experienced investors watch metals not just for profit potential, but for macroeconomic clues. A sudden triple-digit silver price would be one of the loudest clues possible. For everyday viewers, the goal is not panic or prediction. The goal is understanding how interconnected supply chains, currency confidence, and investment psychology really are. Because the biggest financial surprises usually hurt the people who assumed nothing unusual could happen. Awareness itself is often the strongest financial protection. If this breakdown helped you understand what could really break first if silver hits $100, tell us in the comments what sector you think would feel the pressure fastest. Your perspective actually helps shape what investigations we cover next on Bullion Alert HQ. And if you know someone tracking inflation, retirement risks, or the precious metals market, share this video with them so they see the bigger picture early. The more informed people become, the calmer and smarter market reactions usually are. Stay alert, stay patient, and keep watching the structural signals instead of daily noise. Because in modern markets, the biggest shifts always start quietly long before the headlines confirm them.